Welcome to StockMarketPundit.com. What we are going to present is a follow-up of the S&P 500, and I'm going to make it quick. What I'm going to do is that I'm going to go to the monthly chart. This is a weekly one, so let's pull up the monthly chart first, and let's make sure it's in here. There it is. Now, on a monthly level, each one of the bars are a monthly move. And on the S&P 500, the history of the things that I'm going to point out to investors, most people have not been involved in the move. What I want to show you is that at times when we've had stimulants, like you see right now, we always go up, but they give it back, and they have a tendency coming right back where it all started. Here, what I want to point out was the 2002 bear market economy, bear market in general, when Greenspan had interest rates at very extreme lows. In 2003, we went up and made an all-time high in the S&P 500. Basically, guess what? Everything that happened over here at this bottom, let me draw a trend line. The main thing about this videotape is that it's going to show you why you are going to learn mathematically how markets work. Markets go mathematically up, they go mathematically down, but here's the important thing. This was an expansionary period that came off the 1996 level at the bottom of 96. Went all the way up for 4 years. Over here at the bottom of 2003, we went up another 4 years. And each one of these things on this monthly chart, there's a beginning and there's an end. The beginning of the downfall of the move was when these monthly blue bars, are moving average, convergence, divergences, along with other indicators that we work with, had started to show failure, and down we went. What I really want is that this X here and X here is that all the stimuluses, all the exuberances, all the gimmicks, everything that people were led to the woodshed, because they're led to the woodshed all the way up. Bam! You're right back where you started from. Guess what? During that time, the recession was nearly nothing like the depressionary environment over here. And what I want people to know is during that 4-year expansion, we got to the bottom, we created a monthly buy signal, and for 4 years it was an expansionary economy, service side economy, expansionary economy, housing bubble played everything in this area. And everyone was siphoned out of their assets. And we went up, we made a top, but guess what? Ironically enough, right back here, you failed. And it gave it all back twice. Once, twice, once here, twice, 2 legs here. This is the third leg of first leg, count 1, count 2, count 3 is part of this whole overall structure. Excuse me 1 second. So basically what I want people to know is that people were led to the woodshed here. People were led in the biggest bubble in United States history here. They were led to the woodshed. Now each one of these cases is to get everyone washed out of the market, and you rewind the tape. Everyone was heavily short. As the short sales came off the market, you went winding back up and buyers came in. Short sales got heavily on the market, they drove it down, and they've rewound the tape up on a monthly level. Now, we are right here at the first V shape of that leg down. So let me show you the shorter term V. There's an upper V right here, 1400, and there's another V that could go, I don't see that this will happen, but here's part of that upper top of a full V-shaped recovery in indexes. I didn't say economy, but there, that's the top of the overall V. What I want people to know on the S&P 500 is they're trying to lead these markets back to a monthly buy signal right now. And they are. You can see what happens to the monthly buy signals. Sell signals only come around every so often. That's what happened when we had that last sell signal in 2000. Tech bubble. S&P went down. Guess what? Another sell signal monthly. Guess what? Straight down. When you get the buy signals, like you do right here, you go straight up on a monthly level, and they're running it back that way right now. Because every one of these systemic events or every one of these failure events within your government is that Wall Street's role is that to buy this negative area and get it back to the positive area. That's where the wealth is created, is down here. Where the other part of what people are taught in our school is that the more positive that we get within this particular cycle is they're running this thing toward a buy signal on a monthly level. And on a monthly level right now, we'll show you where the bought, overbought, and whatnot, we're at 91.73% on a monthly chart. Well, last time we were overbought over here, we were only at 86% overbought on this indicator right here on the peak of that top before the correction. And what I'm showing you now, see, 86%, 10/1/2007. Now take a look over here from the bottom. That we bought the whole bottom. We're very good at what we do. But we also made all the money when the markets went down here. And what I'm telling investors, traders, people that own IRAs and 401ks, I don't want you to be I don't want you to be a victim when this fails. And I want you to know that this is a 3-month movement, 010 on up. And we've got resistance 1, which we're at right here. This is part of that big down bar. That this monthly bar was a 9/1. September, we sold off hard, and we finally put in the bottom. So basically, as we move up here, you need to keep selling. Don't worry if it wants to go higher. You're dangerously overbought at 91.33% on a monthly on the S&P. And remember, I'm going to show you again. Leg 1, leg 2, up. But failure right back. Remember, what the government does in stimulating, we've got more steroids and stimulants in this economy than ever. We've got the higher unemployment rate than ever is going up. But there is a mechanism, mathematical mechanic part of the market that runs that higher, which is totally separate from Main Street, separate from the economy, separate where everything is. This is just the gimmick part. What happens is that international money is coming into the market in the U.S. because they think it's, undervalued versus their markets. And as they go up higher and higher and higher, psychologically they try to move people in till they finally get them, bam, when you're in. So what I'm telling people right now in the second half of 2010 is that we are overbought on a weekly level. I'm going to go to a weekly chart. This is the monthly level, 91.33.